on all the socials. All right, let's get the party started. Hello, Smart Morning Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Phil Weiss. Hey, Phil.
Hey, Kirk. How are you on this sunny Friday?
Sunny but chilly. It feels like fall
Yeah,
here.
here
It's
too.
yeah. In my new house, the leaves are changing. It's beautiful. My son, we were walking out the driveway, and like, wow, look at all those like colors, like orange and reds, and like it's beautiful. Like we're surrounded by trees now. It's great. Great place until all the leaves fall, and then it won't be great. But that's all right.
Yeah, ours have not quite fallen yet. I'm looking at the trees outside my window, and they're still on the trees. They have just started to change, but they haven't started to fall really yet. A little more time.
Nice. That's a great thing about New England in this part of the country is you get the change in seasons and the beautiful leaves, and I just love it. Especially when you're surrounded by trees that change. I mean, pine trees don't quite work, but when you
No.
get the non-pine, there's tons of pines around here, but is the ones that aren't, it's great. You get a lot of colors, so it's really a cool time of year.
Yeah, it's here. This used to be when it happened, and when the kids were little, we used to go apple picking this time of year all the time, and it used to be great because you go apple picking, and then there's all the leaves that you see around the orchard and on the way there that were changing. It was always a pretty time of year.
I love apple picking. I have to say, it's been a long time since we've been apple picking because no one wants to sit around and go pick apples. And, it used to be, I loved it because they're like, oh, I'm getting a great deal. I'm getting this huge bag of apples for very little money. But now they're actually making a profit on it. And it's more expensive to go pick your own apples than to go to the store.
Yes.
It's a little unfortunate, but
The place I went to the place that we used to go to just because they have a kind of apple that you can't buy in the stores that we really like. But if you want to go there and go apple picking, in addition to paying the same price for the apples, we used to walk to the orchard and then take the tractor back. Now they make you get on the tractor both ways and they make you pay for that too. So yeah, it's just become much more of a profit making machine than it used to be.
yeah, I mean, it's fine. I get it. It's an experience. That's why you do it. And now that everybody has money and people looking for experiences, they're willing to spend for it. I get it. It's just too bad. But, I've always wanted just like an apple tree in my backyard. Like my in-laws have a ton of blueberry bushes on their property. They just came with the property when they got it, and so we go up there blueberry picking. It's like 2 weeks, and you can't pick enough. Like you're there all day, and there's just you haven't even touched the tree. It's like still full of blueberries. It's so much fun. I mean, it's unfortunate it's such a short period, but apple trees you've got like a month or maybe more. But it's a lot of fun. It's fun having that sort of stuff, so you can kind of go out and pick your own. And it's my dipping my toe into farming. I've always wanted to farm. I just don't really want to do the work. I like the idea of doing the work, but actually doing the works, I'm a little busy. So
It's so funny you talk about farming. I have a client or a couple that I work with, and he wants to kind of when they retire be off the grid, have a farm, be able to be self-sufficient. And she's like, have you ever farmed? And he's like, no. So I actually found, and I gave them, and I know they didn't do anything with it, but just to try to make things a little bit smoother, I found you think about, they have like fantasy baseball camps where you can go and there's retired players that you can be with. They have farms like that. So I said, maybe he could go there first and check it out.
that's like what you do with kids. You send them to farm camp, or you send them to a farm for the week, and then they get to farm and do all this stuff, and they come home like, I never want to be a farmer. I'm like, yeah, it's hard work, isn't it?
Yes, exactly.
Yeah, I like that idea. It's like when we lived in the city, they had these things called farm shares. Where they bring a box and it's just full of random stuff that they picked. I'm like, I don't know if I'm getting a good deal here. Like, I appreciate the experience, but like, you're giving me your scrawny stuff. I'm not sure if it's organic, but it's pretty scrawny. And I'm pretty sure I'm not getting a good deal on it. So, yeah, it's funny. I've always had this fantasy of farming, and like 15 years ago, I looked at a house, this beautiful house. It used to be a horse farm. And I was like, oh, it's such a beautiful place. It's got the horse fences and all this stuff. I'm like, this is really cool. We could take it down, put up some apple trees, and it would be such a cool thing. And then I started to think about it. I'm like, that's going to be a lot of work. like I think about, like there are times in my life where I've been up to my in-laws' house just to like work in the yard because I needed it because we live in the city. I just needed that outdoor experience. But now that we have one, like I don't want to do it. I've got my own yard and I don't really want to do this stuff. So it's just kind of interesting the things that we kind of the voids in our lives that we want to fill with stuff. But in reality, we don't really want to fill it. We just like the idea of it. Um, it's kind of like building a fixer, like buying a fixer upper. Like it sounds so romantic, but I don't want to do that. Like it
I
sounds cool. Buy an old barn and convert it. Yeah, I'm not. That's not my. I'm
it's
not
funny.
wired for that. But it sounds good.
It does. And you tell that. I remember when we moved into this house, the woman that owned the house before us, she had this tractor. And I said, I'm going to buy the tractor from her and I'm going to cut the grass and I'm going to save all this money and everything else because it's going to be too expensive to have somebody do it. So I bought the tractor from her and it would take me 3 hours and I wouldn't even finish. And the only part that I enjoyed was my kids were little and a different kid would sit on my lap while I drove the tractor around. My wife talked to the guy that was cutting grass in the neighborhood and it was $40 to cut my lawn. And I said to myself, I know it's not going to take him 3 hours, but it's going to take him like half an hour. But it's 3 hours of my time. That's $13 an hour. That's what I'm saving. That's the savings that I'm getting from doing this. This makes no sense at all. So I sold the tractor. I found out the reason it took me 3 hours was kind of like I said when he would do it faster was the tractor was really too small for the property anyway. And I've had somebody else do it ever since, and I could do so many better things with that time. So it was like that thing. Oh, I'm gonna go cut the grass, right? I'm gonna do it. Yeah, that just didn't work.
I think for people that want to get away from their spouse, it's a great way to do that. You can just be outside all day. It's like golfing. Hey, honey, I'm gonna go golfing. I'll see you tonight. You know? I mean, I love spending time with my family, so I don't enjoy that kind of activity. Like I like golfing, but I don't like it that much. We're going to spend 5 hours away from the family. Like I don't, I'm working all week and I see my kids, but not all day. So like, I don't want to do that. That's not good use of my time. But
Yeah,
but I
agree.
agree. When we were in the rental house the last 5 years, they would have maintenance. I didn't have to pay for it. They just took care of it. And they had this company that did the whole neighborhood. It just kind of went one property to the next to the next. And they have these standing mowers. These guys were like buzzing around like quads, like
Yes.
buzzing around the yard. They got that thing done real quick. And I look at that, I'm like, do I want to? No, I don't want to sit here and be buzzing around my yard. It would probably take me 2 to 3 hours to do my yard. I don't want to do that. Like I have no interest. We probably won't even cut our grass until the spring, just because like we got so much to figure out. It's gonna die anyway. Whatever. Like I don't really care at the moment. We did not buy a house with a well manicured yard. Some people put down sod and they do it right. Now these people just threw some seed down and yeah, there's some stuff sprouting up, but I wouldn't call it a great landscaping job. So we're gonna probably try to do it right in the spring, and so we'll just wait. But yeah, I mean we're gonna be spending a lot of time in the house for probably the next year and just doing work and fixing stuff and there's some enjoyment out of that that you can get and the separation from different types of work. If anybody has, if and this is just kind of I know we're chin wagging here, but for listeners, there's a thing called the Kolbe test, the KOLBE. Kathy Kolbe designed this. It is a wonderful test. And it basically shows you how you're wired. So it's not like a personality test or all these other tests that measure these things that can change. Like this measures cognition. It's something that never changes. So, some people are wired differently. I'm wired in a way that I can adapt pretty quickly. Accountants are wired so they're really good at getting into the details and doing research and organizing. I'm not good at that. Like, so people have their different strengths and weaknesses. Well, one of the things is called implementer, which is basically good with your hands. Like it's a physical, visual, spatial kind of cognition. And so some people are good at that. They're really good at building. Engineers, carpenters, craftsmen who are high in that do really well in that. I'm low in that, which means that if I need to fix a toilet, I need to call somebody because it will burn me out trying to do it myself. I can do it. I hate it. Like I'm doing it. I'm like, oh, this is fun. By the end, I'm like, I'm not doing this again. Where some people love it. And I have friends who just love working on their house and building stuff, and that's cool. I'm just not wired that way. But the things I do love, I could do all day. Just that's not one of them. But I bring this up because for all listeners, this will help you in life, just understanding yourself. I think it's like $40. It's kolbe.com. I think Kathy Kolbe. It's a quick test, take you 15 minutes. It's one of the only tests I use in working with other people because it's so helpful to understand people and how they operate. My wife and I did it. My kids are too young, but when they're older, I'll have them do it. I have an idea what they are. But anyway, my point is, in looking at this, you have these different scores. And even though I'm really low in an implementer, which is like the visual, the spatial stuff, the physical activity, the craftsman working with your hands, even though I'm low in that, it still once in a while feels good to do it because you need to switch gears once in a while because sometimes you're just getting low in one and you're like, all right, I need to spend more time here. Anyway, if you want to learn more about it, there's a book called The Conative Connection by Kathy Kolbe. It's a quick read, well worth doing. Like I said, it's changed my life and helped me keep away from burnout. So I was doing things that were burning me out, and I stopped after reading that. I was like, oh, I got to stop doing this because it's burning me out. And I realized why I was getting burnt out after. And so now I align my activities better. Now, like, I'm full of energy all day. People are like, why do you have so much energy? It's because I'm doing the things that are aligned with my Kolbe. And so by the end of the day, I have more energy than the beginning of the day. It's weird, but it's how it works. Anyway, just some educational piece for everybody, something to, if you're looking to improve yourself and learn new things, highly recommend it. So Phil, we got lots to talk about. What's going on in the markets? What do you want to talk about today? There's lots of stuff we were talking about before the show.
So I think I'll start with what I mentioned to you before we got on. And I'm not doing this to be a doom and gloom guy, and I'm not doing this to scare anybody, but it's just interesting to me, some parallels that I'm seeing between some of the activity in the market now and some of the activity that we saw in the market back in the internet bubble. And let me give you an example. Let me talk a little bit more about it. So back then, I wrote for the Motley Fool. They used to have online portfolios, and I helped manage one of the portfolios. And then the Motley Fool, for a while, was trying to launch an individual company research business. And I was part of that. And one of the companies I covered was Cisco. And for those that aren't familiar with Cisco's story, I mean, back then, Cisco was the internet darling. It was kind of like, when you think about NVIDIA, it was kind of the parallel if we go back to that point in time. And when I wrote my research on Cisco, I spent a lot of time talking to the woman who was head of IR at the time. We had a really good relationship. She gave me a lot of really good information, really helped me communicate a lot more about what Cisco did. And then as the market started to come apart, she left. And I wrote about a couple things on the negative side with Cisco, and Cisco's IR would never talk to me again. But the reason I'm bringing all this up is here's two of the things that happened. One was that back then, Cisco wrote off a lot of routers. They wrote them off not because they were damaged or broken, but because sales fell off so much that if you think about how the accounting rules work, they were no longer considered to be that they were going to be sold within the normal sales cycle. So they were written off, but that didn't mean that they couldn't sell them in the future. So that meant that in future margins for Cisco were going to be higher, because if you write it down and then you sell it, but after you've written it down, there's a lot more profit in it. And then the other thing, and this is where the really big parallel happens, is that one of the things that Cisco and Lucent Technologies and Nortel and all these companies that were selling these routers and other types of internet equipment were doing was they were providing vendor financing. So if a small company wanted to go buy product from them, they would sell it, but they would finance it. So they really weren't getting the money. And eventually those companies, a lot of them went out of business, and those sales were written off, and that's tied to why they had to write off all these routers. And so now, within the last couple weeks, I've seen a couple instances where NVIDIA has made investments in companies. One of them was, I forget the name of it. It might have been Apollo or something like that. But it's a company that's involved in AI. And NVIDIA made like a $50 billion investment in this company. And in exchange, this company is going to buy NVIDIA's products. That feels a lot like vendor financing by a different name. And so what happened for NVIDIA? I mean, this is great, right? Because they now got another $50 billion of sales. And they took this they made an investment in this company. And for it, they're getting more sales. And Cisco trades at multiples of its sales, and it trades at multiples of its profits. And so it's a really good thing. But in essence, they're buying the product because they funded this purchase. It feels a lot like what we saw back in the time of the internet bubble. It's just, there's a lot of parallels to what's going on. I mean, the difference I'm saying, one difference I see is a lot of the internet companies, their clients were retail. I mean, their end customers were retail. That's not as much in AI. I mean, the biggest customers, and like, you're not going to have this happen. Like, I don't see Google and Amazon and Microsoft who are buying so much of this and Facebook. Those companies are not going away. So you don't have total risk, but you do have some risk on these same kind of companies. And it feels like that there's a lot of similarities in the type of transaction. So it's just something to be concerned about. And the other thing too that I know is that if you look over the last few years, back when I was an analyst, I remember I covered Chesapeake Energy and I put a sell on it. And one of the reasons was I spent a lot of time going through the accounting policy footnotes, and I saw changes in accounting policy. And one of the changes you always worry about is when depreciation lives get longer. And that's what Chesapeake was doing. And the advantage of extending depreciation lives is that it means less depreciation expense. If you had a product that cost $100 and you used to depreciate it over 4 years, you took $25 of expense. If you do it over 5 years, it's now $20 of expense. And that type of thing was happening. And I know that even Google and Amazon and Microsoft have lengthened the depreciation lives of their properties. So that is having an impact on their bottom line. From a free cash flow perspective, which is cash flow from operations less CapEx, right? There's some changes there too, because depreciation's lower. The CapEx is still there, but the depreciation that's coming out is impacted. So these are just some things that I'm seeing that the fundamental analyst in me with the accounting background has questions about.
Yeah, I mean, it's good to have those concerns for sure. If you think about economic cycles, a normal economic cycle, our markets haven't been truly free market for a long time. They're managed. But, if you look at a normal market cycle, you have supply and demand that drives behavior, it drives revenues, it drives growth, drives, a lot of stuff. However, when you get later in the cycle, you tend to get these, how should we call them, questionable business practices. They're not illegal, but it's kind of sketchy, right? As Phil talked about, vendor financing. Now, when was the last time we saw vendor financing like this, Phil? Like, what are the time periods where the vendor financing became big?
Well, certainly it was back in the time when we had the internet going on. That was a huge
late
one.
90s.
There was a lot of it in
Yep.
the late 90s. That's the one that jumps out. I'm sure there were others. That's just the one that really jumps out because
I mean,
it's top of mind right now.
Yeah, that's the most recent one. And then you're having a lot of this now. Where I've been seeing this for the last few years, and it's subtle, but now it's getting bigger. I mean, the whole thing we talked about last week with OpenAI and AMD, you're starting to see a lot more of these where the numbers don't make sense, so they just use vendor financing as a way to continue growth, even though you may not. And the thing that concerns me is not that these things are illegal, and it's not that they're wrong. It's that it's an indication of where things are. I mean, if you think about like Enron, for example, now Enron did some illegal stuff, but a lot of what they were doing was they were just moving things around, and they were making things look different. And the company ended up going bankrupt, or I think technically bankrupt, right? So, but I'm not saying that these other companies are going bankrupt, but it obfuscates reality, and you want clean books. And if companies start to do shenanigans like this, to me, it's an indication that maybe you should steer clear of these companies. They could keep growing. I don't know. I'm not the accounting expert. Phil's more of that than me. But for me, it's more of the idea that if you're running a company that's growing, you don't need to play these games. Now, I know big companies do, and they have for a long time. GE was masterful at hitting their numbers every single year for like 20 years. Jack Welch, I don't know the accounting gimmicks he was using, but I know that he magically hit the numbers every single time, like consistently. Like, really? But I also know that they were doing vendor financing, right? That was a big part of the model, at least later in the cycle. And so you really have to wonder, like, what is really going on when you have to resort to these tactics? Now, we've been talking about this a lot in the show, that we've been on the edge of a recession for a long time. And I don't know how long they can keep up the charade. It seems to be working, and people seem to be buying into it and pouring good money after bad. But at the end of the day, like, we're overdue for a recession. I would say the one in Biden's administration was a recession. They just told us it wasn't. It didn't feel like one, but it was a minor one, I think. But it still hasn't been characterized that way. And, we might have one in this administration too, and it probably also won't be characterized that way because nobody wants a recession on their watch. But recessions are healthy, right? Market crashes, as painful as they are, they're also healthy. Recessions get rid of the dead wood, right? It's like having a forest fire. No one wants a forest fire, but if you don't clean it out, then you have this big, huge forest fire, and it burns down everybody's neighborhood. But if you just let nature happen, they happen smaller fires, then it dies out, and then the forest is healthy. But because you don't clear away the dead wood, it turns into these, huge blazes that burn down half the state. So the same thing happens with the economy. If you don't get rid of the dead wood, if you don't get rid of the marginal companies that probably shouldn't exist, and they only exist because you have 0% interest rates, then you're going to have a lot of these shenanigans going on where people are trying to keep the party going, right? The game of musical chairs. What did Jamie Dimon say? Hey, if the music's playing, you got to get up and dance. You turn the music off. Right. I mean, sometime, and where everyone's afraid of a recession because no one wants to lose money. But if you're investing the right way, if you're investing in solid companies, you're not going to be scared by a recession. You don't like it because the stock price goes down. But at the end of the day, you're not getting 20% growth a year that we've had in the last few years. That's not normal. You can't keep up that pace. Right. If you think about a company like some of the largest companies in the world, like Apple, if they're growing at 20% a year, like, you're going to every single person's going to, in like 5 years, every single person's going to have like 5 iPhones. That's not going to happen. Now, granted, their phone prices may be 5 times as much by then for one more pixel on your camera. But regardless, numbers don't go to the sky forever. Right, that's just the truth of it. I mean, you look at some of these big companies. I mean, you look at Intel. Used to be one of the biggest companies in the world, and now they're not, and they've slowed down a lot. IBM, also another formerly big company, and now it's not. Like, companies don't go to the sky forever, right? You look at Apple. I can't remember if Apple's still the largest. Are they still the largest company?
I think it's NVIDIA now.
NVIDIA, okay, NVIDIA's.
I think so.
Anyway, they're one of the top few. They haven't grown their revenue for 3.5 years. How are they still the biggest, and with expectation of growing your revenue at 20, 30% a year, and yet they're not growing? I don't know. What's the PE, 30 something? Whatever it is too much if you're not growing. So I'm not saying Apple's a bad company. I'm just saying when you get to be the biggest, it's hard to keep growing. The only companies that can continue growing indefinitely are, in many ways, financial service companies, because you get massive amounts of leverage based on other people, and it's based on the whole financial system. So many financial companies grow with the size of the economy and the markets. So there are some limitations there, but it's not the same. right? It's not the same as, well, I need 5 iPhones to keep growing, or Apple needs a new product, which they don't have. So yeah, Apple could keep growing if they had a new product, but they don't. They're not innovating since Jobs. He gave them a few projects and they continued. And, I think Cook's been a good manager, but you need an innovator to keep growing. And Apple doesn't have that. Microsoft was poor under Ballmer, did a really poor job of innovating. They did a great job of lighting money on fire. But under Nadella, they've done a great job. I don't particularly love the products, never have. I think their systems are just not, the user experience is not as good as some of the other competitors. But they're doing a great job as a stock. Like they're growing, they're doing great work, they're printing money. So I give them all the credit. So they continue to grow because they have a model that can allow that. But the point is, if you're going to invest in companies, you need to understand the company's business model. Is it going to grow or not? If you're investing in like a Coca-Cola, well, are people going to be drinking more Coca-Cola? Probably not. They've probably saturated the market. They might drink less because of the health issues, but how are they going to grow? Well, they have to create a new product or buy a company, or there's lots of things they can do to grow. But understanding this about companies is really important. So if you have a 35 PE, you're basically going to get your money back in 35 years. Why would you do that to yourself? If Phil had a company and he said, hey, I want you to invest in my company. I said, sure. When am I going to get my money back? Oh, in 35 years. Thanks, Phil. I think I'm going to go light my money on fire somewhere else. I'll go to the casino. I have better odds. You have to understand what you're doing, right? And most people are indexers, and that's fine. There's nothing wrong with being an indexer. If you don't have the skills to invest in companies, indexing is fine. But if you are investing in individual companies, you can't just chase the hot dot. We're having a little bit of a rocky month, and rocky I say in air quotes because rocky is like, hey, we're up and down like 1 or 2%. It's not going straight up. I wouldn't call this rocky. I wouldn't even call it a speed bump. It's more like your car going over a pebble. But at the moment, the markets are not continuing to go straight up. And today, gold and silver are down big. Whoa. Maybe they're going to crash. They went straight up for like a few months. And now I think right now, as of today, silver's down almost 5 and gold's down 1. Ooh, that's a big one. But saying that facetiously for those of you who don't get my humor. But my point is, things don't go up forever. And you have to understand what you're investing in. As Phil says, I can't, let me just relate this and I'll hand it back to Phil. I can't tell you how many people, new clients or even current clients, that call me and say, hey, should we invest in NVIDIA? I mean, yeah, 3 years ago, like before they went up like 1,000% or whatever they did, yeah, that would have been a great time. Now, no. And I think the challenge is most people are late to the game for what to invest in. And that's one of the challenges of individual investors investing in the stock market is you're too late. By the time you hear about it, everyone else has already invested and it's too late. Maybe NVIDIA is going to be a great company for the next 20 years. I don't know. But am I going to overpay for it? No. You can, and maybe you'll make money. I just won't do it. There's so many other opportunities that you can invest to make money that you don't need to try to roll. You don't have to try to win the lottery on one stock. That's not the best way to invest. So, I think we should all take stock in what we're investing in. We've had, as we've been talking about the show, we've had a lot of money in the precious metal space, and we took some stuff off the table a few weeks ago. Not because we think it's going to stop, but because we think it's been a little too much too quickly. And that usually leads to consolidation or pullbacks. And we're waiting for that. Whether it's consolidating or pulling back, we'll just wait. We take some exposure off and we'll add it back later. But you have to understand what you're doing. You can't just throw money in and roll the dice and hopefully you're gonna get what you want. So, Yeah. So just be careful about some of these companies when they start doing vendor financing, because if you don't understand the accounting behind it, you could end up holding the bag for something you may not want to. So what else in the news, Phil? We got earnings this week. I don't know if you've been following that, but we got the earnings calendar here. I don't know if there's anything you like or don't like.
I mean, I just want to add one other thing to something you just said. There was an old research paper that I remember from a guy named Joseph Lakonishok, and he wrote about the persistence of growth rates. And in the paper, he talked about how few the number of companies is that can grow 15%, just 15% a year for even 5 years. And if you look at the companies that have been, I mean, Microsoft, which has been around longer than any of these other companies, right? Because it was even before Apple, we had Microsoft. But if you think about some of these companies, how many more years can they continue to grow, right? And if you've got a company that's valued at trillions of dollars, like how much more growth is there? And it gets really hard. So you have to think about how difficult it is for these companies to grow. To get to earnings, I mean, mostly I haven't paid a really close attention yet, but I know a lot of the banks and things like that started to release because they're always the first ones. JP Morgan talked about some credit issues that they had. I mean, I think that's something that we do have to worry about in general. That if the economy starts to go south, that's an issue on the credit side. I mean, and even if you have beyond just the earnings aspect, you have like the business development companies who function as kind of like private lenders. The stocks of those have taken a recent hit too, because I think that there's some worries out there about credit and whether or not companies that are a little bit higher risk, or even individuals that are a little bit higher risk, are going to be able to continue to make the payments. I mean, I think that's the biggest thing that I've kind of picked up on so far from what I've heard, either around earnings or just around what's going on with companies that I'm also paying attention to.
Yeah, I mean, this week was a big week for financials. You know, if you look at Tuesday, JP Morgan, Wells Fargo, BlackRock, Citigroup, Goldman Sachs, you had companies like Johnson Johnson. But, you had a lot of banks this week. You had PNC, Bank of America, Morgan Stanley, you had some financials, M&T Bank, US Bank Corp, Travelers. Like, you had a lot of financials this week. Like, this is typically the first week of, the quote unquote first week of earnings season. It's heavy in the financials. And if you look at the financial sector, the XLF ETF, it's not too great this week. It's down. And I haven't followed all the earnings missives that they've given out, but if you just look at the stock price, people didn't like it. And if you look at some of the companies like JP Morgan that have done really well for a long time, it kind of fell off a little this week. So interesting to note. Next week, it's a mixed bag, but you got a lot of big names. Netflix, Coca-Cola, 3M, AT&T, Tesla. You got Ford, you got Intel, you got a hodgepodge of stuff next week. And, some important companies in there. The week after is where is this? Is it next week? What is it? Week after? Okay. The week after is Tech Week.
Yep.
So the week after, you've got some big tech companies. You've got Alphabet, you got Meta, you got Apple, you got Amazon. Is Microsoft in there?
Microsoft is there, yeah, and so is KLA-Tencor, which is another tech company.
Okay.
On the 29th on Wednesday. That's where.
Okay. Yeah, I'm just not seeing Microsoft at the moment. But yeah, so it's where all the big tech. Oh, there it is. Okay. So yeah, this is all the big tech companies. You got some large companies this week. So really between this week, next week, and the week after, you've got a lot of big earnings weeks. And then if you go the week after that, it's probably the highest amount of companies reporting. But you also have a lot of other big companies. You got Shell, AB InBev, S&P Global. You're going to hear a lot about what's going on in the markets. ExxonMobil, Visa, HSBC, UPS. So you're going to hear a lot of stuff over the next few weeks. So I'm actually very interested to see what's going to come out. I've had this suspicion, and we've shared this on the show in the last few weeks. October is going to be a bit of a volatile month. It's typically September or October. September was like a crazy good month, especially if you're in precious metals. But October's, I'd be shocked if October isn't more volatile than we've seen yet. And the reason is it's not that I think anything bad's going to happen, but you don't typically see a shot to the moon with markets. You typically don't. Precious metals have gone through the roof. A bunch of stocks have just kept going up. You have certain indexes like if I'm going to try to bring it up here, you have certain indexes like the small caps, which let's see if I can find it here. I don't know if I can find it. Well, I'll keep looking. But there's certain indexes like small caps that are borderline all-time highs. So they broke out and now they're just sitting there, close to all-time highs. Now, that in itself doesn't really mean much, but if you're a technical analyst, if you look at things from a technical perspective, you realize that if it breaks above that, that's really positive for those markets. Okay. And what that means, and I'm still trying to find it. Anyway, if I find it, I'll share it. What that means for you is you're looking for things that are breaking higher. Because what that means is that people are very positive about that sector, and people that look at the technicals will look at it and say, all right, obviously this is going higher, I'm going to invest. But they wait for things to break out before they do that. Because before that, it could easily just break down. So technically, if you hit resistance, so if you're looking for things to go up, it's going to hit resistance. Resistance is like the ceiling. And sometimes it hits resistance and then bounces back down because there's too much resistance. There's too many sellers at this price, not enough buyers. So what happens is then it bounces down. That hits a floor, right? It hits its support. So it hits the floor, and support are all the buyers. So the buyers come in and say, oh, this is a good price, $50. I like this price. I'm going to buy it at this price. And there's way too many buyers. So there's not enough sellers. So it hits the floor and then it bounces higher. And it goes within this range up and down, until you either exhaust the buyers or you exhaust the sellers. So as long as there's enough buyers at that price, you'll keep having the floor there and it'll keep giving support. But when you hit resistance at the ceiling, at some point, the sellers you run through them all and there's buyers, and then it breaks through. And then you have another set of buyers that say, okay, it's broken through. Now I'm going to buy. So you get this whole new set of buyers above. Now, what's happened with the small caps, see if I can share this here. Let's see. Let me stop sharing. I'll share the screen. Okay. Okay. All right. So I'll share the XLF. This is the financials. So this is the last week, right? It's just things have kind of tailed off a little bit. This isn't a good sign, but that's okay. But if you look at small caps, so the IWM is the Russell 2000. Fat fingered that. Okay. So if you look at this, here's the Russell 2000. All right. So if you look at this, right, here's the resistance. Here's the ceiling, right? If you look here, this range right here is the ceiling. And what this means is, things keep going up and then you hit a ceiling and then people wanted to sell. They weren't going to go any higher than this, right? And so what ends up happening is that there's enough sellers and then they push the price down and then they try again and then it hits this and this, went up there and hit it again. And there's too many sellers. So it knocked it back down. Now, of course, this is during Trump's tariff tantrum and knocked all markets down. But now it came back up and now it's sitting here and it's trying to break through. And in the last week, it did break through. It broke through all-time highs and some people started to get on the boat and then it came back down. Well, that's actually not a good sign because typically if it comes back down, it comes down hard and not good. But we're not there yet. It seems to be kind of holding its own. So what this means for you is, okay, in this case, it means that if it breaks through here, you're going to have a whole batch of people buying this and helping it push higher. Just not today, but that's typically how you would read this, right? Is there's a line here and then there's a line down here. So if it crashed and went down here, a bunch of people go and buy it. right? And it would be a great time to buy because there's a huge amount of resistance. You can see all this stuff kind of lines up, right? This is kind of a lesson in technical trading. I don't have charting software on me, or I would try to do this. But you basically draw a line here and you draw a line here, and there's like this little box, and it kind of operates in here. So there's a lot of buying in here. And you notice here, there's buying here too, right? Because it hit this low point and then a bunch of people bought it. That's how you read charts. You look, where are the buyers? Well, there's obviously a ton here. It's lined up for the last like 7 years. And then there's a lot of sellers right here. And so knowing that, okay, it needs to break through the resistance or it's just going to bounce down again. That's why people wait. And so, you have a lot of charts that look like this. Small caps are one of them. I'm trying to remember a few off the top of my head, but there's a bunch. Let's see. XSL, LS, steel. Let's see, there's a steel one. I don't know if I can find it. Oh, SLX, that's what it is. SLX. Just trying to remember that. So here's another one. It's in a similar vein. Like you got a lot of resistance up here. Can't really break through. But this is kind of the last market. So steel, there's the metals. This is typically a sign that the economy is growing. You got copper miners, which have broken out. As you notice, there was a lot of resistance here. Then it broke out. Well, why did this happen? Well, it's because it broke above. And when it broke above, you had a ton of buyers come in and push it up, right? That's typically how these things look, right? And so, you don't get the same thing with like silver miners. I'm just going to show this as a comparison. Here you had a lot of resistance and it broke above, and of course you get it shooting up. So this is how you'd kind of look at charts. See the floor here is right around here for the silver chart, and then the ceiling's right around here. And when you break up, it just starts to rocket. That's what happens with a lot of charts, is that you have these buyers and sellers, and people are looking for these pockets of buyers and sellers because they want to see, all right, where should I buy? Where should I sell? If you're looking at the fundamentals, you're going to miss a lot of this because you're looking at the fundamentals, which have nothing to do with the investor sentiment or the trade, the institutional money. The institutional money is looking at this. So if you want to buy this, that's great. You should also look at this chart to know where to buy it. Now, Warren Buffett might say, I want to buy it down here. Well, that's great. But what if it stays here from 2015 till 2024? Well, you just lost basically 10 years. So maybe it's not a good idea to buy it at that price because it's not going anywhere. So those are just some things to think about. That's why it makes sense to do both, fundamental and technical. So you do the fundamentals to know if something's a good investment, and then you do the technicals to see when to buy it. And we've talked about in the show on the mining stocks, and when you buy them, it's when the spread between the commodity price, the end result, and the input, which is oil, is the largest. That's where you get the most profit because it's basically input in is energy, input out metals. So that's how you analyze it. All right. So what else should we talk about here, Phil? I got lots more here. What's on your plate?
Well, I guess the one thing I would just want to follow up on what you're saying, it really gets back into something that's really important when we talk about investing, is the idea of behavior, the behavioral aspects of investing. That's really what you're talking about, right? Because you talked about emotions and sentiment. That happens so much in investing. Sometimes we have to fight that because sometimes we get too excited, right? And the worst thing, like I will tell you, I'm not a chartist, but I understand them. And the worst thing that can happen is you're buying as it's rising up and you buy it at the peak, right? You got too excited and you buy at the peak, and a lot of money can be lost. So you have to be careful that you don't just buy right into the sentiment like that. That's always a concern. Investor behavior and the psychology of investing is such an important thing to consider for all of us. There's so many different biases that can get in the way. We can be so focused on what's just happened now. We can only be looking for people that agree with us. The recency bias is looking at everything, what's happening now. Confirmation bias is when we only want to look for people that agree with us. It's hard for a lot of people to take a loss because emotionally they don't like to admit that they made a mistake. There's so many different types of emotional biases that can get in here. And that really ties into, to me, a lot of what the technical part of investing is about, because it's about emotion. in terms of the market itself. I mean, the other thing that I just think is it's so interesting is we have this government shutdown. And I know that historically markets don't react much to government shutdown because I mean, that's just what the data says. It has not really had a big market impact. But yet it's sometimes I feel a little bit surprised right now just because nothing's happening. It's like the market shut down and people don't really seem to care enough to do anything about it. Like the politicians that are voting on it haven't moved their position. Nobody's made any changes. And I know the ones that are getting impacted are the workers. Like I have a client that next week we're going to have to take money out of one of his accounts because he's not getting paid. And that part of it often gets lost. And that does have an effect on the economy because when those people that are not getting paid, they're certainly not spending as much as they would have otherwise. So there is an economic effect, but I just feel like the whole thing is kind of being glossed over. There's so many other things going on that we have this government shutdown that people really aren't paying much attention to and not much is happening with it.
Yeah, I don't know if you heard the news, Phil, but there's breaking news that Jerome Powell won the Nobel Prize for Chemistry. I don't know if you heard this.
I did not.
Yeah, he won the Nobel Prize for Chemistry. He's the first person to turn U.S. dollars into crap.
Yeah.
Sorry, it's Friday. I needed to say that.
It's okay. I mean, that was, you talk about that earlier, and I used to use for my client portfolios for the international position. I used to have the hedge version of the ETFs. And earlier this year, because of the stuff that was going on with the dollar, I switched to the unhedged. And so far it's worked out well. I mean, it's a long-term game. It's not a short-term game. But yeah, the dollar has taken a beating relatively this year.
I do wonder, and I made this this claim probably a few weeks on the show, but I'm actually going to pull this up to show it because it was interesting to me. But if you look at the dollar, see if I can find it here. So let's see, here we go. So if you look at the dollar, people have been talking about how the dollar is going to crash and it's going to decline significantly, and it's woe's me, the dollar is going to go to zero, and the people in the world who sing the same tune no matter what time of day it is. Mm-hmm. There's a lot of those, and people want to listen to those when the dollar is going down. It's like, yeah, he's been saying that for 20 years and he's been wrong the whole time. But I guess a broken clock is right twice a day.
Absolutely.
Yeah, I won't say the person's name, but we rip on the show. We're going to have to come up with a name for this person so we can just say it so the listeners know what I'm talking about, but without getting sued. Anyway, so the U.S. dollar in the last, pretty much since this year, it peaked out in the beginning of 25 and has gone from a peak of right around 110 to right around 98. So, that's a drop of 12%. And does that mean that the dollar is going to zero and, oh my God, the dollar is going to crap? No, it doesn't. If you'll notice, pretty much since May, June, it's pretty much gone sideways.
Yeah.
And it really hasn't gone below 96. And everyone's talking about, it's going to break below and it's going to be the end. I hear these podcasters talk about this stuff all the time. And they come up with these really good arguments and logic and all these explanations, and they sound really smart. But where's it gone? It hasn't gone anywhere. So my theory back in September when it hit 96, right here, I was like, you know what? I'll bet it's going to bounce from here. Just call me crazy, but it's going to bounce. It's not going to break through and crash. It's just going to bounce. And that's what it's done. Now, I wish I'd put money on it, but the problem with the dollar is all right, so I'm right. It goes from 96 up to 99. That's 4%. There's not a lot of movement in that. It's kind of it's like watching paint dry. So it's really hard to speculate on something like that just because it's so slow. And the reason that people invest in Forex, which you don't know what Forex is basically foreign exchange, or it's currencies. It's investing in currencies, is you could have massive leverage on these things. You used to be able to do 100 to 1. You put up $1 and you could have 100 to 1 leverage, which is crazy. 1% move will wipe you out. And so you could get massive leverage in these things. So that's why people used to trade it. But you need massive leverage to actually make money in this stuff because it moves so slowly. Anyway, my point is it still hasn't gone anywhere. And people are still afraid. I hear this all the time. Oh my God, what's going to happen with the dollar? Nothing. Nothing's going to happen. You want to have some perspective. Here's some perspective. This is the last year and a half. Okay, let's go back to 2020. Let's see what's happened. It was pretty much smack in the middle of where we were. Let's go back further. It's dead smack in the middle. High of 120, low of 75. Right now we're at 98. We're square in the middle. So are we afraid the dollar's going to crash? Not really. Compared to what? Compared to the euro? Compared to the yen? Right? Compared to the Australian dollar, Canadian dollar? Oh yeah, we're in terrible shape. And I think what people don't realize is what makes up the dollar. Well, here's what makes up the dollar: the euro, the yen, British pound, get out of the way, Canadian dollar, Australian dollar. I don't know if there's any others in there, but like that's what makes them up. They're not going anywhere. They're all crap too, right? So I think what people don't realize is we don't realize that our currency is an exchange for something else. Gold, you're exchanging dollars for gold, right? Or gold for dollars, right? Vice versa. It's an exchange. If I buy a car, it means I don't want dollars, I want the car. If I sell my car, it means I want dollars and not the car. You're always exchanging dollars for something. So in the currency world, the US dollar, it's comparison to something else. It means you want the dollar, it means you don't want the euro, the yen, the pound, Canadian dollar. Or it means you do want it. So let's take the Swiss franc, which is always a pretty stable currency. A lot of people want the Swiss franc and they don't want their other currencies. That's just how it works. There's an exchange, there's a balance. So when you look at the dollar and you say, oh my God, the dollar is terrible and Trump's destroying it, compared to what? The global currencies are managed. I'm going to shed some light on this for all you people. Global currencies are managed. They're managed by the governments and the central banks. Do you think any one of them wants their currency to crash? No. They want their currency to be cheaper, but they don't want it to crash. So everyone's trying to devalue their currency because it's helpful to them, but they certainly don't want it to crash because that would be a bad thing. So they're all managed. They all talk. Hey, maybe you should go down 2% today. I don't know this for a fact, but I would not at all be surprised if that's the case because they have to manage a complex system. And the fact that the system doesn't implode every other day means that there's people up there trying to manage it. Not always successfully, but that's why, when you have things that happen, right? Like this year, it dropped a lot. Okay. We had a new administration. For one reason or another, the markets didn't like it, but interest rates are dropping, which is probably part of it. But when we had look here, when interest rates were going up, the price of the dollar went up because I would rather buy a 5% dollar that's really, really highly secure than a 5%, Brazilian real, which is less secure for the same interest rate, right? So that's why the dollar went up. But this is all just bouncing around. It doesn't matter to most people because everything is devaluing. If you want to know, if you want to really understand it, compare it to the metals, compare it to gold. This is gold, the price of gold. Come on. The gold price isn't going up. The dollar is going down. It's the same thing. But the dollar, you saw, well, the dollar's not doing this. Yeah, compared to everything else, because everything else is going down too. So the way you have to look at things is not just gold's going up, but everything else is going down, which means you want to be in the things going up. So the result is the same, but your perspective, you should look at it from different perspectives. It'll help you understand how to look at these things and why these things are going up. It's because the dollar's going down. It's because it's being devalued. Anyway, we got to wrap it up here. So Phil, final thoughts here as we wrap it up.
I mean, the other thing that you mentioned that's really important when you look into currencies too is interest rates, right? Because why is a 5% dollar something? The interest rates in the US are 5%. You're getting 5% to hold the dollar, right? So interest rates also factor in. That's just another element. And the dollars and all these different currencies are exchanged. They're just all units of exchange. That's really all that they are. Um, Thanks for having me on today, Kirk. Enjoyed the conversation. Sorry that neither of us really get to go apple picking much anymore.
Maybe next week, Phil. The apples
Yeah.
will be there.
But like I said, I still go and get them because this place we go, they this one apple that we really like. I buy a lot of them. My daughter's coming home from school for fall break next week, and one of her questions is, "Daddy, you gonna go get apples before I get home? I need to be able to bring some back with me." So, I'm Phil Weiss. My firm's Apprise Wealth Management. I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. As I said, my firm's Apprise Wealth Management. We'd love to get to know you. You can visit our website at apprisewealth.com. That's APPRISE Wealth. And if you go there, you can read our blog or and sign up for our weekly newsletter. Again, thanks for having me on today, Kirk.
Yeah, thanks for coming on, Phil. And that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a shorting and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email to express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.